All right, so we'll get started. If any of you guys have to drop in, I'll record this. We'll share the recording afterwards in case you missed anything. This offering is the Sutton Park Lane. It's currently named Ivanhoe Apartments, so we'll be doing a rebrand immediately. We're Reed Capital, main sponsor on this deal. We're vertically integrated, property management, construction, asset management all in-house here. If you don't know us, haven't invested with us before, a little background. I started in real estate investing in 2013 with a single family rental. Quickly moved into multifamily in 2018, and we've just grown from there. So we're at 336 units here in Dallas. With Ivanhoe, we're going to be 532, roughly 50 million in assets under management right now. Just a reminder, this investment is open to accredited investors only.
Tanner, I do the asset management, and here are critical dates list. Offering docs are in the portal. You should expect to receive an email in the next few days, and you'll be able to go in the portal and electronically sign. Soft commitments are due tomorrow. We're roughly 73% funded. Equity funds are due December 16th. Once docs are signed, once we send that email in the next few days, and once your docs are signed, you're free to send your funds in. It's on a first come, first served basis. So once we're fully funded, we'll put you on the wait list.
Yeah, we've got our instructions in the portal as well.
The closing date, roughly January 6th.
This is the deal structure right here. So we do an 8% preferred return. And how the waterfall works is, your preferred return is paid out. Then it's a full return of your capital. And then after that, it's a 70-30 split. And your preferred return is cumulative and compounding. So any preferred return that's not paid out compounds annually every year. And this 10% is, we just always leave that in there. Our sponsor contribution is usually a lot higher than that. We've been anywhere from 50% of the equity on this deal. I think probably 20, something like that, 20%. Exit strategy, we always say 3 to 5 years. It's really, I think interest rates are going to kind of dictate the exit here, but we could probably plan on, at least 3 years, 3-year hold. So the offering, this deal was pretty unique. Let me see if I can. This deal was brought to us by a broker in California, KW. They were representing the seller on a disposition in Beverly Hills. He told him he had a Dallas property that he was willing to sell. They did a little research into the area and found out we had just bought Paxton Lake Highlands, and they called us, asked if we'd be interested in taking a look, and it turned out it looked like a deal to us. So we were really the only group in the mix here, truly off market. It wasn't being shopped at all. So I think we did get a pretty good deal on this one compared to if it went to market. As I said, we just bought Paxton at Lake Highlands in July. It's in the same sub-market, less than 2 miles away. We're exceeding rent projections on that deal right now. So, all signs point to that being a really great investment. This deal is right across the street from Topgolf, so it's really well located. Average home price you can see here is $532K, 88,000 median area income. And if you don't know Dallas, Lake Highlands is really one of the places to be in terms of where you live. Brent, can you tell us about financing options here?
Yeah, obviously debt these days is really what's dictating a lot of the deals, whether it's an opportunity or not. We have underwritten this deal at a 65% loan to cost at a 7% interest rate. That's fixed over a 3-year period with 2 1-year extensions on that. We've also negotiated $1.5 million through the seller carry. And how we structured it at 0% interest first year, 4% years 2 and 3. So significantly less than what we'd be paying on the senior loan. And so that's going to help us to be able to cash flow the property better. And so there's additional options that we're looking at to kind of give you an idea of what floating rates we're looking at. The best deal on a floating rate deal that we were looking at, Bancorp came back with a 65% loan to cost. Which is 405 basis points over SOFR. We would have to pay for a rate cap. So in doing so, that just floating rates really explode and make it not a deal. There's an option we were looking at with where the negotiations with on a balance sheet lender, and those terms would be at a 65% loan to cost, 7.25% interest fixed, 3 years. So some options there. We're also considering a debt fund group. So this is a group that offers a very attractive 5.5% fixed interest. They'll even loan all the way to 90% of the capital stack. But we're only really seeking 70 to 80%. And the caveat on that deal is that they are a recourse loan. So in those terms, we're negotiating that deal in the terms, but the sponsors are definitely open to doing a recourse loan, so that's definitely on the table.
Yeah, that's by far the best option. 5.5%. No one's anywhere close to that. So yeah, really only downside for us is it's full recourse, but it's the best thing for the deal. So we're definitely pursuing that route. Great leverage too. We'll probably land. As Brent mentioned, up to 90% of cost, which is really aggressive. We're not trying to be as aggressive at this stage of the market. So I think we'll land somewhere 70, 75% of cost. And, there's some unique, we can get into, I guess, more of the structure of that deal later on in the Q&A period. But is there any other questions you guys have right now on debt while we're here on the topic?
Kitesh, again, I may have misheard, but just to recap, it's going to be about close to 10 million from equity partner and sponsor contributions. And then debt financing is about 20 million. Is that correct?
Yes.
Okay. Could you repeat?
That's at 65% of cost. That's what we have modeled. So we're trying to do a little bit better than that on the leverage and interest rate. That's hopefully worst case scenario. So I think we'll land somewhere between, if this life insurance company works out, we'll be 70-75% of cost. They're at 5.5% interest. These other options.
Yeah.
High level.
So high level, you're looking at a floating rate, 65% loan to cost with at 405 basis points over SOFR. That would require a rate cap. A fixed interest rate through a balance sheet lender at 7.25% interest and 65% loan to cost.
Okay. It sounds like
then you have the debt fund option.
3 different options, but the life insurance debt is the front runner right now. Is that correct?
It is the front runner. That's correct. Yeah. This time of year is really challenging. A lot of the lenders are just kind of sitting on the sidelines. They've made all their allocations for the year. So getting anything done has been pretty slow. Ideally, any other time of the year, we'd have several, formal term sheets in hand. Have we gotten any solid term sheets at this point?
No.
Formal? Yeah. So we're still having these conversations with lenders, fielding questions, and compiling this. But it's really tough right now due to the holidays. But we have gotten some soft indications, and that's what we're running through right now. So there's still, when we talked to our debt broker today, there were still 7 or 8 groups that they hadn't heard from yet. So things are just moving extremely slow this time of year.
Understood. So assuming we're looking for an exit strategy in about 3 to 5 years, and there is probably a recession coming and interest rates are going up. So what is our strategy to safeguard us from the recession point of view and also from the interest rate going up point of view?
The main strategy is just avoid all floating rate. That's going to be, worst case scenario. I don't even think we'll probably entertain floating rate whatsoever. I mean, there's just all the unknown that we're experiencing right now has to do with floating rate debt and interest rate caps and trying to predict what's going to happen, and it's virtually impossible. So that's why we're really only entertaining fixed rate debt.
Okay, fixed rates for 3 to 5 years, or what are we looking at?
Correct. Yeah. Most of these products that we're looking at are 3-year base term, 2 1-year extensions minimum.
Thank you.
Hey guys, Jose here. So on the rates that you guys have mentioned, is that factoring in the market consensus that the Fed are going to increase interest rate in December again for another 50 basis points, or that's in addition to what you guys say?
It's tough to say what's going to happen with that next increase. So the rates we're getting right now are current day. Some have already baked in that increase. Or you would hope most, if not all, have. But it's hard to say. Do you have anything to add on that? What lenders are saying?
Well, the reality is once they actually, that's why they're so slow to provide hard term sheets, because once they do that, they're committed and they move forward and they commit to that interest rate. So they want everything, all the due diligence tied up immediately up front before they actually provide. That's why there's more back and forth now with lenders compared to previously. So I think that like the ones that we're working with right now, they've pretty well baked it in, like the debt fund group. So hopefully that'll be where we can make it work.
Yeah. So simply, yes, most have the December increase baked in right now. So we have been getting 7% indications and better. So I think we still have some options. I think we still can beat projections here, but there is a chance for it to increase.
Okay, thank you. Yeah, it looks like the others might hold on until the meeting. But that's good. Okay.
So in kind of looking at these sale comps here, there's the key thing to note about these sale comps is these are ones that were not renovated at purchase. Paxton at Lake Highlands, you see the second one is the property that we own. That property is one of the exceptions. The interiors were renovated across the property. We have infused some capital in the exteriors, but for the most part, that's a renovated property. The rest of these you see here are non-renovated at the acquisition, and most of these are currently going through heavy rehabs. And then the property Meadows Crossing there that you see, where it's at a price per square foot of $213 on sale. We have in our projections, actually on exit 5 years from now, 10% less price per square foot than that Meadows Crossing property.
10%.
Or 10% more, excuse me.
Yeah, just about 11.
Yeah.
So another key thing to note with Paxton, that was a renovated property, great shape, but renovated in 2016. So it was getting tired. We've already done quite a bit of work to that property. So yeah, while being a renovated asset, it was renovated 6 years ago. So that's a key thing to know. And, we're at almost 127 a door here. So I do think we're getting this at a discount from where the market was, just 3-4 months ago.
David, you say we're buying here at 147 per door?
127.
127. Okay, perfect.
Right. Yeah. Let's pull up the model real quick so you guys can see. Yeah, just under 127, 156 a square foot. And you can see here, that in 5 years, this is what we're projecting to exit at. 241 a square foot, which is just, 11% over Meadows Crossing here. And this is Forest Ridge is another deal, a little bit newer, good looking asset. But again, this one wasn't renovated either at purchase. We've covered most of this. Good, healthy median area income, 88K, median home value, healthy, great rent growth over the past year. And this is specific to the East Dallas submarket, which includes Lake Highlands. You want to go through this pro forma, Brent?
Yeah, so we have the vacancy set in there through CoStar's forecast, which is an average of 7.29%. The disposition forecast for CoStar as well as at 4.91, so we're conservative, 5.5% on the exit. And then you can see there the rent increases that we're going to be pushing, so you can definitely see that they're under market currently. Some of the value add opportunities that we see at the property is in the property currently is not billing tenants for trash. So that's going to be a value add of $33,000 annually in revenue. Implement a bulk tech package, and then that would garner $40 per month per tenant value add to the property. And then taking advantage of like reserved parking, both covered and reserved spaces on the property.
Yeah, so we have sensitivities in here, but just to give you guys an idea of how much that exit cap rate moves the needle here. Even exiting at a 5.25, how this moves our IRR and equity multiple 5%. So definitely a lot more upside to this deal. These are all, this is where we're getting our data for our underwriting. This is CoStar. Put that off there. This is CoStar, coming from CoStar data, both historical and their projections. Sensitivities that we just talked about. Waterfall. And so some of these, go ahead. Someone have a question?
Yeah, this is Venkatesh again. Could you go back to the previous slide for me?
Waterfall?
Yes, thank you. So I do see different tiers here, tier 1, tier 2, tier 3. Could you tell me the difference between those?
Yes. Let me pull up the model. So these are for different hurdles. If we were using them, we like to keep it simple and just 8% preferred return, 70-30 split. But if you wanted to do, any, up to up to a 12% IRR. Once we went over 12%, then maybe it was a 60-40 split or something like that. That's where those tiers would come into play. But right now, really the only tier that is factored in is tier 3 and 4. Does that answer your question?
Yes. Is there a possibility that might change in the future, or?
Maybe on future deals. This deal, no. Yeah, the
Okay,
waterfall
so
system.
it's only one tier then, 70-30 split. Is that correct?
Correct. Yes. 8% preferred return has to be paid. It's cumulative and compounding. Any dollar over that is a return of capital. We have to return 100% of your capital. And then every dollar over that's a 70-30 split. And that will not change.
Thank you.
So we're planning to renovate roughly, is it 7? Yeah, roughly 7 units a month, which is pretty conservative. Renovation downtime, 25 days, which is pretty conservative for us. Some key things to note from the recent rent roll that we just received. So you can see, the market rents that we have set here versus the in-place rents, and then right here are post renovated rents. This is our pro forma rents right here, 1866. This is their latest rent roll. They've leased one of these 3-bedroom units within the last 30 days for 1850. So, and it's showing the C1 right here is an unrenovated unit. This C1P is one of their renovated units. We've already completed our full walkthrough of the property, and it was, their renovated units were, we classify them as partially renovated at best. They were kind of all over the map, and a lot of them looked like they were renovated quite a while ago. So the fact that they're getting these rents right now indicate that, there's still some runway there. So we thought that was pretty encouraging. Renovation schedule here.
Could you go back to the renovation schedule for me?
Renovation schedule? Yes.
Yes, thank you. So we are considering renovating 86 units in the first year,
Correct.
75 in second, and 34 in the third year. Is that correct?
That's right.
Okay. What is the renovation budget?
It's roughly $3 million total, with the exterior CapEx included. So
Okay. Is that
average per unit cost right here about $8,100, and then and all this is in the portal too. If I'm moving fast, this is all in here for y'all's review. This is a summary of the exterior projects we have allocated for.
okay? So is the CapEx or the renovation budget part of the T12 we have seen previously, or that's a separate? Okay, there it is. Thank you.
Yeah, you can find the total on the sources and uses page of the underwriting model.
Okay, I don't have access to this page yet. Maybe I should explore in the portal. I'll look at it later.
Okay. Yeah, the model is in the portal, but if you can't find it, just let us know. We're happy to email it to you.
Will do. Thanks.
I didn't mention So these are a few photos of the property. We like that it has this unique kind of Tudor style design. We've got this, we're waiting for our design team to complete their design package. We'll have some 3D renderings from them to share with everyone, hopefully in the next week or so. So we're excited to see what they come up with for the exterior and interior designs on that point. I didn't mention some of our partners are here. We've got Daniel Galvin, Robert Downs, we've got Satch Bernhardt, Jolene Varney, Lee Martin, and Ryan Dumas. So they're our partners on this deal. Our sponsor summary is here for you guys to look at. You've heard from Tanner and Brent. Really, I mean, that's the pretty much the summary of this offering. Is there anything else any questions that anyone has, anything that we kind of covered too fast or you would like to rehash?
Hey guys, Jose here. So I'm very familiar with your team. I invested with you before, but can you share with me and with everybody else what is the role of Galvan Investment in this deal? And nice to meet you guys. I know you guys are on the call, but I'm not clear about what the role is here.
Yeah. Galvin Capital, we did our first deal together in 2020. They invested with us on a deal in South Dallas, just as LP investors, and they've grown in their investing career, and now they have their own real estate investment firm. They're raising capital, and they invest with a select handful of operators like us. So that's their role in this. They're basically raising their own fund, referring investors here, and part of the management team in this deal. Danny,
Dave, thanks for the intro. Appreciate it. So I would say right now we have, I would say close to 2,000 doors that we actually loan sponsor on. We not only raise capital, but we also have a real strong network of equity partners that invest where we invest, and we also invest our own money, right? So just about every deal that we raise money on or we sign on debt for, we leave our money in the deal, right? Whether it's escrow money, right, hard money that we could potentially lose if we don't close, we typically leave it in. We do like to write those bigger checks. In Paxton, as David knows, as in Paxton, we not only raised a couple dollars, but we also wrote a pretty nice check for that one as well. So, but we're very select on the kind of operators that we like to partner up with, because we have a very strong following of investors that like to invest where we invest, because we vet. We're very good at vetting out operators. So I hope that helps you out, Alfredo.
It does. Thank you. And so besides money, are you also planning to have a voice in the table as far as, maybe giving recommendations or best practices that you've seen in other deals that you have done elsewhere, or is just financial
what?
That's it.
Listen, the cool thing about Reap Capital is that we don't like to babysit projects. We do when we have to, but we don't babysit Dave and his team, because they're really, really good at what they do. There are a couple projects right now that we're babysitting that we're not excited about. That's something that we don't like to do, but we have to get involved sometimes. But
okay, thank you.
Absolutely.
Yeah. So another thing that these guys they sit in on our weekly asset management meetings as well, and help on that front, give input, and they are active in the management. They're more than just capital raisers. So they're a true partner in this deal, in every deal they're a part of.
Okay, thank you.
What else we got? Lee, I know you got some questions.
Hey, buddy, I think you guys are doing a great job. Did I hear you say you guys had a bank offer you guys 5.5%
That's right.
recourse, right?
That's right. Yeah. So I'll try to explain that. So this is a unique structure. They're 5.5%, which is by far the best interest rate that we can get in this market. The full recourse is one consideration. The other is their structure is it's any cash flow over the debt service is split. So 65% goes to us and our investors, and they take 35%. So if we end up pursuing that option, we'll share the waterfall, but we'll tell you that the returns look much better than what we have modeled. So even on a 3-year hold, the model is showing over a 2x with that structure. So, and that's due to, it brings our equity requirement down from 10 million to, 6 or 7, depending on the leverage. So a lot less equity in the deal means higher returns for everybody else. And, yeah, I mean, it's by far the best option if we make it work.
And also in that situation, they also do not share in the depreciation.
Yeah, that's another key. Yeah. Good. Thanks for bringing that up. Yeah. Let me pull up that cost seg. What was it? What were we at? 4.8. Is that right? Yeah. So we've gotten a cost segregation estimate here. I believe it was 4.8 million. 5.9. So the initial cost segregation estimate right now is 5.9 million. So if we go with the higher leverage option, that's nearly, if we're at 75, 80%, that's nearly 100% or more, 100% of depreciation, depreciation equal to 100% of your investment. So that's going to be hugely beneficial for a lot of people. If we're here at 9.6 million, based on 9.6 million, that's about 61%. So anywhere from 61% to 100% of your investment could be written off due to depreciation in year 1.
Also, there's a question, David. Somebody in the chat asked when we would be expecting to roll out distributions on the preferred return. At what rate?
8% preferred return. We're not projecting any cash flows year 1. Really, I wouldn't expect. The underwriting model is showing plenty of cash available year 2, but yeah, I would probably say give it a year and a half, maybe. The next question: can there be capital calls? Yes, there can be capital calls. But another thing we're doing to mitigate the uncertainty in the economy and rising interest rates is carrying a much larger reserve than normal. So if we go to the higher leverage option, anywhere from 70 to 80%, we're going to carry $1 million reserve. Right now, with a lower leverage, 65, 70%, we're going to be about 400 or 500K. So we're going to be carrying a pretty healthy reserve. And, really, if additional cash ever has to be contributed, it's going to come from the sponsors first. I mean, we will give everyone the option. So if we do need additional cash, we'll give you the option to contribute so you don't get diluted, but it's not going to, it really won't be a requirement. If we're short of cash, it's, I feel that should be our burden to bear.
Guys, Jose here again. Can we go over one more time with the sensibility analysis and maybe show us the worst case scenario? I mean, in this time of uncertainty, I mean, that's what at least is on my mind, and I'm sure in a lot of investors' mind is, what is the worst case scenario that we can see? We're all happy with the best case scenario, but I wonder if you're gonna walk us over that one really quick.
Okay. Yeah, absolutely. So this, what the model that we're sharing with all of you is kind of our middle of the road model. We've got a different model that we share with lenders that's more aggressive, but we also, we stress test this too. So, one key thing to note is refinance interest rate. There's a lot of people that think the Fed is going to reverse course sometime next year and start lowering rates, maybe 25 bips at a time. So if that's the case, 3 years from now, we think we may be able to refinance at 5.5%. So let's say that doesn't happen, rates maintain, we refinance 7.5%. It doesn't really move the needle that much. We're still at a 1.8x, 15% IRR. Okay, now rent growth is another pretty big assumption here. Let's play with these numbers some. Find them. There we go. So can you pull up what CoStar is showing for 23? Most submarkets, CoStar is still forecasting double-digit rent growth in the Dallas area. We've got year one set at 5, so maybe we're kind of flat, 2% across the board.
So we are right now projecting for 6.192 is what CoStar is projecting for 2023.
Yeah.
So
Yeah, that must be recently updated.
yeah, prior in that you catch part of the second half of 22, which is not included in this, is 10.819. So almost 11% there.
Yeah, still double-digit rent growth in 22. Definitely, they're forecasting this to scale back. So 2%, you pretty much flatline our rent growth. Definitely affects returns, but you're still beating any other alternative that there is out there, as far as I know.
Perfect. Thank you.
Any other scenarios anyone would want to see here? Another thing to note, we're pretty heavy on the expense side. So you can see their T12 numbers here, and we're higher on repairs and maintenance. We're higher on payroll, higher on advertising, much higher on admin. All of their turnover, they have included in their 345 unit for repairs and maintenance. We've got a separate $150 a unit for turnover here. And another key thing to note, property taxes. And we've already gotten a lot of pushback from lenders on this, thinking we're being way too conservative, because the numbers we use for property taxes are coming from our CBRE tax consultant. And this is what that looks like. So these are the numbers we're using, but if you look in here, I mean, year one is the reassessed rate. That's what they're forecasting for 23. Year two, it's like a 22% increase. Year three, another 21% increase. So I think this is probably pretty unrealistic.
I guess my last question, sorry, this is Jose, is since we haven't secured the loan yet, what is the worst case scenario there? Let's say that the Fed increase interest rates again in December, and everybody we're talking to says, "Oh, now it's 8.5%." What now? Is that the best case scenario that we have starting on December 14 before closing? Are we willing to walk away or not?
Yeah, we're always willing to walk away. Absolutely. So, all these pursuit costs, we bear that burden. We've got 250,000 plus at risk right now, probably more like 300, with these additional pursuit costs. So, that's absolutely something we're prepared to do. Yeah. So if our initial acquisition loan went up to 8.5%, let's see what that does to the numbers. I mean, it's not
huge.
yeah. I mean, let me share my screen again. So it brings it down to a 1.81x, 14% IRR. The issue is going to be year one. You see our unleveraged cash flow, debt service. So, we'd be using 209,000 of our reserves year one. So not the best option. I think we could mitigate some of that risk by just increasing our reserves significantly, over that 500,000. But I don't know, how would you feel about that, Jose?
I think that's right there in the red line, brother.
Yeah.
I think it's too close, to be honest with you. But you know the market better than I do. But that might be a red line for me.
Yeah, it's not ideal, but Donnie will tell you the deal we did in 2018, we had a 7.5% no. That was fun, even back in those days.
Still worked out really good.
It did worked out well for us. What else? Anything else? Everyone's tired, still tired from Thanksgiving?
No, looks like a good project. Congratulations, and let's hope for the best.
We will. So yeah, next steps, like Tanner said, everyone, if you're signed up on the portal or you've been included in any of these email blasts, you're going to be notified of signature requests that the offering docs are ready. They're in the portal for your review. You'll get a signature request so you can go in there and digitally sign when you're ready. Wiring instructions are in there. Once your docs are signed, you're free to wire. And we're over 70% committed right now. We got 7 million committed. So once the money's in the bank and we're fully funded, you'll be added to the wait list at that time if you don't make the cut. And we've completed pretty much all of our physical and financial due diligence at this point. We've done our walkthroughs. There's not a lot of unknown. The biggest challenge that we have now is securing debt. So, like I explained earlier, everything is moving incredibly slow, not just due to the time of year, but all the uncertainty and what's going to happen in December and February. So that's the biggest challenge we have right now. We do have a 30-day extension that we can utilize if we need it. That'll push us into February. So we will definitely keep all of you updated along the way. We appreciate all of you joining us tonight. If as you're reviewing documents and any follow-up questions, anything like that, feel free, reach out to any one of us. Any one of the partners on this deal. Happy to answer any questions that you may have. Appreciate you all joining us tonight. there's not any other questions, we'll let you get back to your families.
Thanks, guys.
Nothing else.
Thank you, guys. Appreciate it.
Thank you, everyone. Appreciate you joining
Appreciate
us.
your time.